Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. Hello, everybody. We are sitting down the week of April 10th, and this week we have special guest Mohit Arora, colleague of mine and Zane's, the other Energy Desk host. And Mohit and I are getting together this week, talk about some of the interesting trends that we're watching and all of the different statistical models that we're running. But a high-level overview with Mohit's background, VP of Risk Analytics and Decision Sciences at Mobius. And I will turn it over to Mohit just to give a kind of brief rundown of how he got to Mobius and what the day-to-day looks like.
Thanks, Alex. Glad to be here. Quick background, been here at Mobius for almost 7 years now. Prior to coming here, I was trading crude and natural gas options for the prior 20 years. Started at Koch Industries. Then I went to a JV of theirs, Entergy Koch Trading, which got bought by Merrill, which became Bank of America with the financial crisis. And soon after that, I left and joined a $2 billion hedge fund here in Houston called AAA Capital. And then most recently was back heading up the options desk at Koch and was there for about 5 years prior to joining Mobius. So most of my life in trading has been in options and trying to understand the asymmetry of commodity markets and how to take advantage of that. Mm-hmm. And part of that is also understanding what those risks are. So you want the asymmetry to be working for you. And that's what I love about options and managing tail risks. So That's really what I bring here, which is trying to figure out and try to build analytical tools with my team to try and understand how we can help our clients mitigate those risks and where those opportunities come about in the markets and how we can help them take advantage of those.
Yeah, exactly. Yeah, one of the projects that I get to work on with Mohit is a pretty fun one. We call it, the heart, or just the all-seeing entity that knows what's going on in the market. So that's been a lot of fun to build with you. So I look forward to keep doing that. But today, I think one of the things that some of our colleagues, when we have our team meetings, we're talking a lot about the speculative positioning and some of the different positioning metrics that we watch. And, I think we are sometimes the two outsiders and our interest in this. So this will be a little bit of our outlet to talk about what's going on in the hedge fund space and both commodities and I think some of the financial instruments that are pretty interesting and indicative of what is happening, what responses we're seeing for the tariffs and OPEC bringing production online. And as we look at, yields and what's going on with, say, the basis trade and what happens when, those have to unwind. I think those are all pretty interesting trends to monitor. So I think maybe we can start it off. And if you want to just kick it off with the energy space, I think one of the ones that over the last few weeks that we've been watching, kind of last few weeks of March, was what's been going on with Brent hedge fund positioning versus, say, WTI. And I think that definitely comes back around to what's going on this week.
Yep, agreed. Yeah, that's one of the things which we've been seeing, that there's been very, very low length in the TI market, and shorts have been increasing over the last few weeks, but not spectacularly, leading to a pretty low net length in TI. Contrast that with Brent. Sorry.
No, I was just saying, and low open interest too, which is pretty interesting. Everybody's on the sidelines. So, but go ahead and continue with Brent.
And on the Brent side, it's very different. We've seen over the past 3 weeks, almost 135,000 of length come in and some shorts covering. So your longs are longer and your net has increased quite substantially by almost 160,000 over the last 3 weeks. And note that this data is as of the Tuesday before Liberation Day. So I think some of that net length got liberated from profitability.
Yeah.
Because I expect over the next 3 sessions, most of that would have come out. The new data comes out tomorrow. I would expect that besides the length exiting, there would have been shorts getting added on to potentially both contracts.
And it really accelerating the change. Yeah. And just some context on the last 3 weeks for Brent. I think it's one of the more fascinating parts. The 56 million barrel change equivalent in contracts last week in net length. And that, looking back over the last 10 years or so, is a top percentile change on a week. And we've done that almost 3 weeks in a row, like you said. So to see it come on so quickly and come off so quickly, I think is very much what is going on as we look at the past 3-4 days and a really past week. So that was especially interesting. But I think one of the ones that you mentioned that I haven't been tracking on is the spread between heating oil and RBOB, and really where that came into play this week.
Yeah, that's the other thing which was interesting is we're going into gasoline season, so you'd expect people to be getting positioned long. And you saw that over the past 3 weeks. You've had about 25,000 contracts net length added over the past 4 weeks in RBOB. On heating oil, it was the reverse. You've got pretty high short interest, and that's increased, and length came out. And you basically had a net short position, which is unusual for the spec community. And that is even more surprising given that distillate levels in inventory are actually really low while gasoline is okay.
Yeah.
So now fast forward a week later, and what you found is that the commodity which was long, which is RBOB, has gone down faster than the commodity which was more short, as you would expect. But that's really the kind of information that positioning tells us is if there's an acceleration in one direction, what does the positioning tell us? Is it where it's really short and you'll get a very fast spike up, or is it long and you'll get a, rapid decline?
Right.
And
yeah, sharp.
this spread in the crude world, this is called the widowmaker, just like the March, April in natural gas. And there are people who trade RBOB versus heat. And this is something which they watch, is which way is the positioning.
Mm-hmm. Yeah, and the skew is really what comes into play when we're comparing to the other macro side of things. But, I think taking a quick detour from the positioning, we'll come back to some of the financial stuff. But talking about the product side, one of the narratives that I think it's been kind of affecting the market on and off for the last couple of years with all of the, prolonged calls for recession in the US and elsewhere that we haven't seen and increasingly are seeing expectations rise for that, but still not seeing that. When we look at the product demand side, I think that's really one of the interesting points of contrast to that narrative is that you have, as you mentioned, you have low inventories for distillate. But when we look at total crude inventories as well, those are low for OECD inventories. It's easily gaining, as we discussed, but still lower than the 5-year seasonal range. And then specifically for product demand, we see in the US, at least, you have total product supplied. The most recent readings for the DOE was 19.4 million barrels a day, which is above the 5-year seasonal average of 18.7. The same thing for gasoline product supply. We got 8.4 million barrels a day versus 5-year seasonal average 8.25. And distillate is significantly above. That's outside of that 5-year range. So you have 4 million barrels a day versus the seasonal average of 3.7. So I think there's a little bit of the conflicting narrative. I see that extend across other economic indicators too. I think the payrolls is a great example. You have job growth, at least in the February, March reading. And, today we got the CPI print that showed lower inflation. So I think there's a lot of these narratives that are increasingly bearish, but they're not really grounded in what we've seen from the data per se. Is there anything that you've seen that would maybe contrast against that, that would substantiate maybe the bearish narrative?
I actually would say to start with that the narrative is getting ahead of itself. If you looked at what the entire financial macro market did, and I put crude in that macro bucket. So you had all the equities sell off hard, same with crude, and that's where that demand thing comes off. The cracks actually did not come off much. I mean, RBOB came off some, I think, because of positioning, but if you looked at distillate, it actually went up.
Right.
And so at the end of the day, if demand is going down and you're going into a recession, it's your product which should be the one which should be impacted.
And
and
right.
yes, and it's not.
Yeah.
So yeah, I mean, I think there's a lot of narratives out there, and I don't think the data is matching those narratives. I mean,
Yeah.
there's so much of recession. I mean, recession risk going up to 60% or 70%.
Right.
It's like,
Yeah,
and
the
then you get
banks.
data coming out, which is like, this doesn't quite fit in with that.
Yeah, yeah, exactly. Yeah, I think on the global stage, I think that's kind of an interesting puzzle to try and put together, especially in the last week or so with tariffs and retaliatory tariffs and all these different measures getting thrown around, particularly with the US and China. China, obviously, one of the world's largest consumers of all energy products. US is a major exporter of all things energy. So it's definitely a internal debate that I'm having is for China, you have property sector crisis kind of extending through last year. So you have kind of a downside skew for, say, distillate consumption. And then you get into a trade war with the US and you're going to have to increase your spending to support your economy, make sure your currency doesn't appreciate so that you can maintain exports. And then you also have this massive, massive debt problem. And all those pieces come together. Seems like China's demand would be kind of pointing to the downside, but it is also kind of this on the flip side. Is China going to be the demand driver for the global crude market going forward? I think as we've seen over the last two years or so, there's not as much meat left on that bone. And so I think really paying attention to other large developing economies like India will be particularly relevant during the trade kind of back and forth. Yeah, I guess within that, is there kind of a broader macro theme or takeaway that you've been at least just observing or piecing together?
Yeah, I think the China story's been going on since COVID, and it's been the imminent increase in demand and going back to the pre-COVID days.
Mm-hmm.
And pretty much every economy went back to the 2019 levels. I don't believe China did. I don't have the data in front of me, but I know their property sector never did. And that's a huge driver of their economy. And coming into trade differences or war, whichever word you prefer, the thing to remember is the US is the world's largest consumer.
Right.
And I was reading some stats. It's between 35 and 40% of global consumption in terms of consumers. And so we are in a really good spot in terms of driving that discussion of, hey, this is fair or unfair.
Good leverage, yeah.
Right. And on the China side, they have basically built their economy on exports. Their consumer has never really developed to the extent, I'd say even India is far ahead in terms of developing their own internal consumption. So I don't think they're in a very strong position to negotiate because the US can find other people to get stuff from, but China cannot do anything. They've already got all the factories built.
Right. And you can't just create a new consumer.
You can't just, right. There is no one to replace the size of the US. So I think that'll be really interesting to watch in terms of how the discussions go with all countries other than China, and then what happens with China specifically.
Right. Yeah, it's interesting to see the posturing come on so quickly, especially considering the starting position. You can't really have a high confidence prediction and kind of how quickly things are changing. But one of the pieces that I do think is especially relevant, and this will bring us back to some of the financial instruments for the spec positioning. There's a lot of commentary about the impact for U.S. sovereign debt, and especially looking at, say, 10-year yields with the large foreign held treasuries for countries like China. And for interested readers, put out a piece yesterday, so Wednesday, April 9th, on who actually holds what are the foreign held U.S. treasuries and what does that mean in the context of overall marketable U.S. public debt. And I think that the primary takeaway from a lot of this is that people overestimate the impact that China could have, especially when you look at the balance of the largest 10 holders of U.S. Treasuries. So if you go down the list, number one is Japan at 1.1 trillion as of the beginning of 2025. So 1.1 trillion in U.S. Treasuries. China, number two, 760 billion. And then you go down with the UK at 740 and progress down to about 300 billion for Switzerland at the kind of tail end of the top 10. So with that, what does that mean in the context of overall U.S. marketable public debt? China's share of that is 2.66%. And I think that is kind of the stat to keep in mind, is that while, yes, they do have significant holdings relative to other countries, relative to overall U.S. debt, it's a little bit of a rounding error conversation, especially when you have the trade negotiations going on. You have other elements at play, Federal Reserve and all these different levers that can affect the yield. So I think with that, though, the other side is on the spec positioning with hedge funds on the 10-year notes and 5-year notes. You see the basis trade kind of indicators still happening. We saw this in the latter half of 24, especially, but these record short positions on, say, 10-year notes. And really that's just kind of indicating I'm long the cash bond, short the future, and I take advantage of the basis with some kind of arbitrage in between. I think that right there is, I guess, the yields plus maybe some other currencies. What are the trends that you've seen that I think are, or that you think are relevant to what's going on now?
Yeah, I think to add to that, I think you and I were talking earlier as well, the positioning in the yen, which is the borrowing currency, that is pretty much at a 1-year high, which is telling you that at least in the currency markets, people are expecting risk. And so they were either covering their positions or going long the yen. And that is evident in that positioning. The other thing which I was seeing in terms of the treasuries, which you mentioned, one of the key pieces of information people are looking for, I think you covered that in your write-up yesterday, was how would that 10-year auction go? And people are thinking that, you know what, it would be underbid and there'd be some kind of disruption. Actually, it was very well subscribed, and a lot of it, I think you mentioned, it was like 88 or 89% international buyers. So it was not a, hey, America, we don't care about you. It was like, we really want more of your debt.
Right. So, yeah, a little. I kind of interpret that. So that, as you said, 87.9% of the accepted bids were represented by international buyers. So that's a record high. The flip side, direct participation. So the kind of domestic tenders, the accepted directs, those fell to 1.4%. So definitely not super strong for directs, but record for international buyers. And I interpreted that as kind of a vote of confidence in the trade negotiations with many of these countries saying, hey, we'll continue to support this. We want to be a part of, the U.S. economy and take advantage of the friendly relationship. So I think that's particularly interesting. And with the yen side of it too, I think an interesting puzzle is the yield differentials. So China's 10-year today about 1.38% or so, and the U.S. 10-year is sitting at 4.385% right now. So you have a decent size spread between those. And I think that's one of China's concerns as they begin raising rates. What is the pace that they can raise rates, and what does that mean for capital outflows? And that's, I think, on the other side of what you mentioned with the funding currency with the yen. I think people recognize maybe U.S. yields are going to be coming down potentially faster than the market anticipates, and Japanese yields are going to be potentially rising faster, but we'll see. Yeah, I think, that kind of covered my side of the spec piece. What else would you like to add to that, if any?
Yeah, I think it's going to be a interesting next few weeks, because from what we hear from the current administration, there's about 70 plus countries which are in the process of negotiating or renegotiating trade deals. And like you said earlier, the narrative is doomsday, but as these new trade deals get announced, and particularly with friendly nations and allies, I think a lot of that has got to give way to optimism.
Mm-hmm.
And in the meantime, I think there'll be a lot of volatility, if you want to call it that, just like we saw yesterday, which was,
Yeah.
and you see yesterday went up, I mean, pretty much risk on in everything. And today you're getting a pullback because you again getting that, hey, it could be a slower than expected. It's not just an instant trade deal, in one day or something. So I think it'll be interesting to see how things really reset.
Yeah.
Because it's not going to be a straight line. And I think it's going to catch people by surprise. And that's why it becomes very important to look beyond just energy or just commodities and look and see where you can find information, because like the currency markets are far bigger, and so are the bond markets. Those are the two biggest markets, the deepest markets in the world. And you can get some signals from there.
Absolutely. Yeah. The one of the funny parts of yesterday's pause for the countries that didn't retaliate to the reciprocal tariffs, it seemed a little bit like, people call the art of the deal type of concept, but just the psychology behind that in the market seemed pretty interesting to observe from the outside. You have strip away the original reciprocal tariff announcement, and if Trump came out and said, hey, we're going to do a 10% baseline tariff on all countries and then raise tariffs on China to 125%, it would have been cataclysmic. I think the market response would have been potentially far worse or equal to what we saw this week. But then by having his starting point, basically setting the reference point for the market at the 10% baseline with reciprocal tariffs on so many different trading partners, and then pulling back, you get this bullish reaction instead of this, the world is ending, Chicken Little type of reaction. So I think that was pretty funny to, just see that play out as it did. I think one of the other aspects that I don't really have a clear takeaway, but one that I'm watching that I think people might also find interesting is we're at a point in the industrial manufacturing space. I think it's an inflection point that it's hard to compare to historical trends, because historically we've had a massive reliance on human labor. But as we approach, I think in mid 2025, we're going to start seeing more and more wow moments in the robotics space for manufacturing. I've talked about this with Zane previously, but Figure is one of the American robotics companies that's working on humanoid robots for manufacturing. And they have trial runs right now at BMW's Spartanburg, South Carolina plant, and seeing the progress for them over less than a year period is remarkable. And the rate of change of technology, I don't think is well understood, well captured by this market sentiment that I think is really weighing on the various commodities and industrials and overall economic expectations right now. And the same thing applies to AI. We talk about this, you and I, when we're talking about the heart concept or this all-seeing entity, but the ability to create or to add productive value with tools and have that labor leverage that doesn't rely on humans is, I think, a paradigm shifting moment. And that's not really, I think, reflected in sentiment right now. I think people expect it to be, oh, you have to bring manufacturing to the US. That's going to take, 10 years to develop a new plant and get your labor force set up and all of these different factors. But I think in reality, we're probably looking at single digit years on the high end, in my estimate, for many of these applications. While some of the more intensive operations, obviously, those might not be as quick, but I think generally people don't recognize what's happening, especially for the young adopters. And final point on that, I think one of the interesting sound bites that I heard on social media on X, I think you have some of these economic commentators discussing this first in, first out type of reaction for the labor force in the US. So when you have younger employees coming into a business, they're typically going to be the first ones fired in any type of economic turmoil. I think that also is one to pay attention to, because who is typically the population that adopts technology the fastest? It's just the youngest group. They're the most familiar with the tools. And when we have, as I said before, this inflection point or a paradigm shifting moment with artificial intelligence and robotics, the youngest population is going to be the one that is going to be driving the change with those tools. So I think those are I guess, two pretty strong levers that I expect to see play out in the next 6 months or so. And as you said, surprise a lot of folks in the space.
Yeah, I mean, it's interesting that you mentioned things like replacing or not necessarily needing humans for every piece of the manufacturing which you bring here, because I was looking at or listening to some talks by Musk, and one of the things he was talking about is he's got these humanoid robots coming out of the Tesla factories, and his goal is to make 10,000 of them by the end of this year.
Yeah.
And I know they're using those already on their factory floors, and I saw some videos of that. It's fascinating.
Yeah, the Optimus.
And they're talking about, I mean, when you bring AI into it, apparently the way he's looking at it is that they're going to learn from us by watching.
Yeah.
So you don't even have to train them. They train themselves by looking
live
at you,
observation.
what you do. Exactly.
Yeah.
So that was one fascinating thing. And the other one is when you talk about how long it takes, I was watching an interview, I believe, with the CEO of NVIDIA.
Mm-hmm. Yeah, Jensen.
And I don't know if you saw that one, where he was saying that they put up this massive 100 to 200,000 NVIDIA cluster, what normally would have taken a year plus because of planning and execution and everything, it took 19 days.
Yeah, that's Musk's.
To finish. And it is insane. If you can do things at that scale, at that speed.
Right.
And we know that this administration has already announced that over the next 10 years, they've already got something like $5 to $7 trillion of investment.
Mm-hmm.
Well, then it doesn't need to take 2 decades to put that to use. It'll happen a lot faster.
Right.
And again, that gives us the leverage because we'll have the investment here and we don't have to go by looking at how quickly can we get a labor force working, because we can use AI and humanoid and other robotics to rate that.
Yeah, I think the XAI data center that you're talking about, the 19 days, I was talking to Zane about that. To me, it's very much that 4-minute mile. You break the barrier, and then the rest of the industry can follow. And I think when you look at the knock-on effects of that for energy, it's fairly indicative, I think fairly obvious of how quickly new demand can come online. And so I think that also brings in another offshoot of opportunities and risks, different time for the generation to come online versus demand coming online. So there's questions there. But I think the broader question also for the robotics piece is what is required to build those. And when you look at the supply chain for making a robot, so you need your metals, you're going to have your battery minerals, and then the daily consumption for generated power. So on the metals piece, I think that also plays into the tariffs on the steel, aluminum, and other metals. So interesting to see those stay in place, really trying to bring domestic steel production back online. And then I don't know if we've discussed this before, but the Congo, the DRC minerals for security deal, after Trump discussed that with Ukraine, the DRC reached out to the Trump administration and said, hey, we would love to do this type of deal with you. We have these M23 rebels on our border and they're capturing territory in the same region that we produce almost all of the world's cobalt and copper. So significant copper, but most of the world's cobalt. And they reached out to the Trump administration. They say that they want U.S. mining entities to come in and help them develop it, but also provide security. I think you have a lot of these variables at play. Same with Greenland. So like all these different pieces coming together, I think it's moving towards that outcome of how do we do this?
Yeah, it is interesting. I mean, you mentioned Congo because the more amusing one was when that whole White House fiasco happened with Zelensky in terms of the mineral deal. Russia said, hey, we have more of every single one of those. How about we cut a deal?
Right.
So, I mean, Ukraine is not the only game in town in terms of the minerals. So that was one thing. The other thing is the U.S. is probably the most energy-rich country on earth.
Yeah.
And if manufacturing comes here, like you said, low-cost energy, it's here.
Yeah.
And the last point I want to make was when you're talking about how much of that is here in terms of manufacturing. Again, as looking at car manufacturers and Tesla again, and they are over 75 to 80% stuff is all here. Everything
Domestic,
from parts to the batteries, to the chips, to the software, everything. So definitely can be done here, much as a lot of the narrative is that, oh, we can't do that stuff. And I think for national security, it's very important. I think that was the biggest takeaway from the outside that I got is when you're dependent on someone else for medicines, for protective equipment, and think in terms of times of war. I mean, if you're dependent on someone else for steel,
your adversary, no less.
You're done.
Yeah.
You don't even need to go to war. I mean, it's all over before it starts. So getting that back will also give us as a country much more security in ourselves. I mean, self-dependent and not being dependent on an adversary. So
Yeah, exactly. I think it is pretty funny. It's amusing in a great way to observe just all of the Musk related entities in the manufacturing space, because you hear him discuss this in a lot of their calls that they're a manufacturer. They're not a technology or just a car company. They're a just manufacturer. And the high technology manufacturing, you see it with Starlink too, where a lot of the Starlink satellites are produced without any human intervention. They have humans observing and monitoring and designing how the entire facility will run, but the actual unit to unit production is no labor. So I think those are the types of technological feats that the US is extremely capable of. And it'll be pretty fun to get to live through that. So I'm definitely optimistic, and it sounds like we share that as well. But I think that's a great place to end it. And we'll throw some good stuff in the show notes for people to check out. As always, reach out to us at mobiusriskgroup.com, and look forward to another chat one of these weeks here soon.
Looks good. Thanks again for inviting me. Thanks all.
Thanks for joining us at The Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.